It didn't do anything meaningfully for American consumers. It is like squirting the water gun at the wildfire. So lots to talk about with the bond market. The US Treasury has had to intervene to lower long-term bond yields because of how much volatility is happening in international bond markets. And in very simplistic terms, what's basically happening is that investors are becoming concerned. There's a lot to be concerned about, but sometimes investors, they all just wake up one morning and are like, I don't like where things are headed. And that happened over the last few days. And I'm going to put it into this framework that I always put it into when I talk about what economic era we're in. Investors woke up a couple of days ago and said, things could get bad. This is my everything's bad quadrant where we have high inflation and low growth, resulting in, some upward pressure on interest rates. So what's bad that investors are getting scared about? Well, they're getting scared about breakdowns in global cooperation. I'm kind of lumping real wars and trade wars into this because I feel like they have the same effect, which is that global cooperation goes down. We're not trading with other countries. We have tariffs, we have aggression, and that means that globally economic growth is going to slow down. When countries cooperate with one another, we're able to increase global economic output. And when they're not cooperating with each other as much, global economic output goes down. And this results in higher inflation and lower growth, something that economists call stagflation. So investors are worried about the war in Iran. And I think just like the possibility of more conflicts like this, whether they are military conflicts or economic conflicts. They're also very worried about debt. So the US debt just keeps getting bigger. And the bigger it gets, the more investors get worried about our ability to pay down our debt, especially 30 years from now. That's why you see a lot more volatility in the very long term rates. There's a lot of volatility there because nobody really knows the world is going to be like 30 years from now. So anytime there's like bad vibes, those longer duration yields tend to get impacted more. But yeah, debt is a concern, a lingering concern. And it's not just the debt. If the United States was seen as a competent country with a bright future ahead of ourselves, then investors would feel like, okay, you got a big debt, but you're on track to pay it off. No problem if you're going to pay it off. If anything, I'm going to buy more debt because I am so, confident in your ability to pay it off. So on the one hand, you have a growing debt, and on the other hand, you have, I think, less faith in the US government's ability to manage its finances, unfortunately. So that's why we're seeing a lot of volatility. It's not just the United States. Globally, like the issues of global cooperation, this hurts countries besides the US more than it hurts the US. Like if you're a little country, and you're being impacted by the Strait of Hormuz, like if you're Bangladesh, I'm not saying is Bangladesh little, they're a huge population. Anyway, if you're like Bangladesh or Sri Lanka, it's a very big deal that the Strait of Hormuz is closed. And if there are more shocks like this, more countries are going to be in a very tough situation. But that does end up putting the US in a tougher situation because when global bond yields increase, investors get better returns going globally and outside the United States. So in order for the US to keep attracting investors, they have to increase their yields in order to compete globally. So even stuff that happens in these other countries, it impacts our ability to issue bonds. So what happened is that the Treasury, they intervened in markets and the longer duration bonds, and they did buybacks. Yeah, 40 trillion on Wednesday, which is kind of unprecedented. A little bit of precedence in the Biden administration with Janet Yellen, but they're taking it further. Um, and I think the reason this is surprising is because at least it's not clear to me what this really accomplished. Mortgage rates didn't move. I mean, they moved a little bit, but they came right back up. So it didn't, for the thing that I think everybody focuses on, mortgage rates, because it's something very tangible to people in the United States, whether their mortgage rates goes up or down, like literally determines whether somebody's able to buy a home or not at a certain price. So for the US Treasury to do all of this and for it to not show up in mortgage rates, I don't know like what the point was. 30-year bond yields, they were impacted, but like regular people don't buy 30-year bonds. At least I don't. Say in the chat, do you buy 30-year bonds? I feel like it's mostly corporations that have these much longer time scales where like, if you're IBM, you need to worry about your 30-year outlook in a way that's different than an individual who has, a limited lifespan. So, I don't think regular people are really impacted by this unprecedented measure that the US Treasury took. So if regular people aren't impacted, like what was the point? I don't think, correct me if I'm wrong. I don't think that there was like a really an imminent danger happening. If there was actually an imminent danger, the Fed would have done something. What's kind of unprecedented about what happened is that the Treasury took on this function of stabilizing markets when that is more the Fed's role. I mean, obviously there's some ambiguity over who does what here, and it's not just Besant who did this. Yellen did it too. So, it's not unprecedented for the Treasury to intervene this way. It just, when there's an emergency, the Fed can act really quickly. So, since the Fed didn't act, I'm skeptical that there was a real emergency here. And then I'm back to the question of like, what was the point of this? What was the point? I really want to know pod says never bought a 30-year. Yeah. I don't know anybody who's bought a 30-year bond. Let's go over to TikTok and see what comments we got. Keep protecting that yen. Eventually it won't be enough. I'm glad that you brought up the yen and international currencies. Part of this is like, I think the US Treasury thinks about things in a more diplomatic way than I think the Fed does. I think so. I think that's right. So it's possible that the reason they did this was for diplomatic reasons. Nothing to do with the housing market, which is my area of expertise in US economic, like how the US economy is doing. So if it was for international diplomacy reasons, I would like then it makes sense that I don't understand why they did it because it was for reasons that I don't understand. But another thing that I wanted to bring up is that like this kind of heavy-handedness in markets is something that China does, and it's something that the US is more allergic to, right? Free market US. So it's also, I think, just interesting that the US Treasury is moving in this direction. I feel like in a lot of ways, I don't know if this is a controversial take or not. I feel like in a lot of ways, we're like getting closer to the way China does things. I went to China in when was it? 2016 on a work trip when I was working for Amazon. And it was very like, this made this really big impression on me because like at the time it was a culture shock going to China, you know, they do things differently. When you're there, you're being surveilled, right? Not that different from the United States nowadays. China intervenes and in private companies, the US is starting to do more of that. So maybe this is another sign that like we're getting closer to China. And I'm not trying to really make any claims whether that's a good thing or a bad thing. I'm sure China does stuff that's well, I'm not making any claims about that. Just an observation. Just an observation that things that the United States previously would have thought of as foreign to us, not so foreign anymore.